Good morning, ladies and gentlemen. On behalf of Capital Trust Research Private Limited, it gives me immense pleasure to welcome you to our research webinar featuring our initiation coverage of Sunshine Holdings PLC and Wata Plantations PLC. We are pleased to inform you that Capital Trust Securities was ranked #1 for the calendar year 2021 in terms of transaction turnover, brokerage turnover, and number of transactions. Capital Trust Securities is also ranked #1 for the financial year 2021-2022 so far in terms of transaction turnover, brokerage turnover, and number of transactions. It is indeed a milestone as 2021 is the year in which the Colombo Stock Exchange recorded its highest ever turnover so far. We wish to also kindly remind our clients that during the period of 2010-2011, when the Colombo Stock Exchange recorded its highest ever turnover up to that period, Capital Trust Securities is also ranked #1 in terms of transaction turnover.
Good morning, everyone. Thank you, Prashani, for the introduction. Let me start this presentation by giving an overview of Sunshine Holdings Group structure. Sunshine Holdings operates in 3 core verticals: healthcare, consumer, and agriculture. The company also has a large land bank, which is held under its fully owned subsidiary, Sunshine Packaging Lanka Limited, which generates rental income. Under the healthcare segment, Sun has an effective holding of 72% in Sunshine Healthcare Lanka Limited, following its merger with Akbar Pharmaceuticals. Under Sunshine Healthcare Lanka Limited, the company is engaged in retail and pharmacy operations through HealthGuard, as well as pharmaceutical distribution and pharma manufacturing. Through its subsidiary Sunshine Consumer Lanka Limited, Sunshine operates its branded tea business, which includes Wata, Rankahata, and Zesta tea brands, while also having exposure to the confectionery business through its acquisition of Dainty Limited in August 2020. Under the agribusiness, Sun has a 50% stake in Sunshine Wilma Private Limited, which in turn owns a 74.24% stake in Wata Plantations PLC. Wata Plantation, meanwhile, owns 89% in Wata Dairy Limited. Sunshine Holdings PLC is a diversified conglomerate with strong contribution from core segments: healthcare, consumer, and agriculture. Sun is considered the 2nd largest local pharmaceutical player. The group's consumer sector includes branded tea, where Sun holds a 48% market share with renowned brands Zesta, Wata, and Rankahata. Sun has a 43% market share in hard-boiled candy, sweet categories via its acquisition of Dainty Limited. The agri-segment operations are carried through the most profitable listed agribusiness in Sri Lanka, Wata Plantations. This includes 3,300 hectares of palm oil and one of the only 2 palm oil processing plants in Sri Lanka. Wata also includes dairy farm operations, which focuses on providing premium quality fresh milk to leading brands. As you can see on the graph on the right, the agri sector is Sun's cash cow, contributing to the majority of Wata's profit and accounting for 53.2% of EBIT, but only 20.5% of revenue. Healthcare sector contributes 51.4% of revenue, but only 20% of EBIT. The consumer sector contributes 22.6% of revenue, but only 5.5% of EBIT. The EBIT margins for the 3 core segments for financial year 2022 is forecasted as follows: the agri sector, a very impressive 60.5%, healthcare 8.9%, and the consumer segment a modest 5.73% due to the lockdown affecting the operating environment in financial year 2022. Over financial year 21 and financial year 22, Sun has restructured the company to focus on growing its core segments through many divestments and new acquisitions. The company has carried out multiple divestments of its non-core businesses over the last few years. Some of the divestments are as listed below in chronological order. September 2021, divestment of Sky Solar Private Limited to Windforce for a consideration of LKR 265 million. In April 2021, divestment of Voltrim Energy Limited for consideration of 545.3 million. In May 2019, divestment of Hatton Plantations PLC for LKR 1 billion. The company has also successfully raised capital through joint venture partners over a period of time. In May 2021, Japan's SBI Group has invested $2 million in Wata Dairy. In March 2016, USD $3 million investment was raised from Duxton Asset Management into Wata Dairy. Sun in the past also focused on inorganic growth of its core segments through acquisitions. Some of the acquisitions are listed below. Jan 2021, acquisition and subsequent merger of Akbar Pharmaceuticals Private Limited for LKR 2.3 billion. In August 2020, the acquisition of Dainty Limited for LKR 1.7 billion. In June 2019, Wata acquired a 31.75% stake held by Duxton Asset Management in Wata Dairy at a discount for LKR 180 million compared to the initial investment made by Duxton of $3 million. The agri sector consists of its 37% effective shareholding in the most profitable agri business listed in the CSC. Sun's effective holding in the dairy business amounts to 33%. Its dairy operation consists of producing fresh milk to Sri Lanka's leading brands. In the healthcare segment, following Sunshine Healthcare Lanka Limited's merger with Akbar Pharmaceuticals, Sun's effective shareholding in the healthcare sector is at 72%. Currently, Sun is the second largest local pharmaceutical player in the country. Sun is Sri Lanka's first fully integrated healthcare company, starting from manufacturing up to retailing of healthcare products, including last mile distribution across the country for all healthcare products. The company is also said to be operating in all 5 segments of the healthcare supply chain, namely R&D, manufacturing, importation, distribution, and retail. With regards to the consumer and retail sector, Sunshine Consumer Lanka was established in 1998, and Sun's effective holding in the FMCG business is 100%. The group's consumer sector includes branded tea, where Sun holds a 48% market share, with renowned brands Zesta, Wata, and Rankata. Other players within the sector include Unilever, Dilmah, and a few other regional players. Sun has a 43% market share in the hard-boiled candy sweet category via the acquisition of Dainty Limited in August 2020. Now that we have a general understanding and background on Sun's core segments, let's look at Sunshine's cash cow, Wata Plantations, in more detail, as it contributes over 53% of Sunshine's total EBIT. There is a misconception that Wata is a mere plantation, but if you look at the forecasted PAT for financial year 2022, it should be noted that Wata is the most profitable listed agribusiness in Sri Lanka. One should understand the majority of the company's profits are in fact generated via its crude palm oil processing mill. The 3,300 hectares of palm oil plantations only provides the required fresh fruit branches required to produce the crude palm oil at its mill. The plantations are actually just part of the palm oil mill's supply chain, enabling the company to operate at high profit margins. In addition, it should be noted that the revenue generated via the crude palm oil sales is a hedge against the LKR depreciation, as the price of a kilo of palm oil is linked to the landed cost of a kilo of imported palm oil plus an applicable duty. So in a scenario where the LKR depreciates the USD against the USD, the average selling price of a kilo of crude palm oil is expected to increase, which will result in a higher profit margin for Wata. Sun's agri operations are carried through Wata Plantations. Wata is one of the largest crude palm oil producers in Sri Lanka and Sri Lanka's most profitable vertically integrated listed agribusiness. a controlling stake of 74.24% in Wata is held by Sunshine Wilmar, which is a JV between Sunshine and Asia's leading agribusiness, Wilmar International. The crude palm oil segment adds 83% to the segment's top line and 90% to the segmental EBIT. In October 2020, Wata achieved the milestone of becoming South Asia's first roundtable on sustainable palm oil, certified palm oil operation. The certification strengthens Wata's leadership as the largest and only certified producer in Sri Lanka. Wata also recently modernized its palm oil processing mill at Nakia by upgrading the machinery to improve the process efficiencies and increase capacity. Its current capacity is now sufficient to process the expected 8 to 10% increase in yields from its palm oil operations, palm oil plantations that is expected year on year until 2026, after the replanting exercise the company carried out in the recent past. If you look at the listed companies exposed to the palm oil segment, it is evident that Wata's palm oil revenue is 3.07 billion, almost 2.5 times more than the next highest palm oil revenue generator, Namunkula. Even though Namunkula and Elpitia have larger palm oil plantations and higher yields, Wata is the sole owner of Sri Lanka's largest crude palm oil processing mill, which contributes majority of Wata's gross profits. Whereas Agalawatta, Elpitia, and Namunkula collectively own AEN Palm Oil Processing Private Limited, Sri Lanka's only other palm oil processing mill. Agalawatta, Elpitia, and Namunkula each have a 33.33% stake in the mill, so only 1/3 of the profits from the mill will be attributable to those three plantation companies. The demand for palm oil in Sri Lanka is significant, with per capita consumption of edible oil being 10.4 kilos per year per person, while 50% of the packaged products at supermarkets also use palm oil. The country's edible oil requirement is estimated at circa 160,000 metric tons as per the Palm Oil Industry Association, and production is insufficient to meet domestic demand. The factory mill in Nakia has the ability to process an input of 15 metric tons of fresh fruit branches per hour and has the capacity to produce 14,000 metric tons of crude palm oil and 1,350 metric tons of kernel palm oil. As you can see in the graph, Wata's palm oil operation generated high profitability in comparison to AEN during financial year 21. The profitability continued to be strong, with net profit margins at 61.9% in the first half of FY22. Wata's more efficient processing mill and cheaper fresh fruit branch procurement enabled the company to have a significant increase in margins compared to its only competitor in the market. Wata's palm oil selling prices are expected to hold steady in the second half of financial year 2022 based on forward contracts. Palm oil prices increased significantly by 66.63% year on year to USD 1,253 metric tons in 2021, mainly led by unfavorable weather and labor shortages resulting in weak output in Malaysia and Indonesia. Indonesia and Malaysia are the largest palm oil producers globally, with annual production of 44.5 million metric tons and 19.7 million metric tons in 2021-2022. As per the Council of Palm Oil Producing Countries, palm oil prices are expected to stay elevated in 2022 as production will remain constrained due to soaring fertilizer costs and long-standing labor shortages. We forecast global prices to witness gradual decline from the second quarter of 2022, led by the improvement in Indonesia's palm oil production. Malaysia's plan to permit foreign workers into the country to ease the labor shortages, and the price decline in competing oils such as soya bean. However, given the expected LKR depreciation in financial year 2023, we can expect average selling prices to possibly increase in LKR terms. We conservatively assume that the ASPs will remain at current levels in the second half of financial 2022 and marginally decline in financial 23, ignoring the possible benefit from the LKR depreciation. We expect the palm oil segment to maintain EBIT margins through the second half of financial year 2022 and financial year 2023, given the expected volume growth to offset the conservatively assumed decline in ASPs. As mentioned before, Wata's selling price per kilo of palm oil is arrived at by taking global palm oil prices, adding freight costs, and adding the import duties applicable to imported crude palm oil. To ensure that the locally manufactured palm oil is priced attractively compared to the landed cost of imported crude palm oil, a discount on applicable duties is provided to customers. Thereby, the company is expected to be a key beneficiary of the imminent rupee depreciation and the current elevated freight costs. Sun is looking at diversifying its operations to include dairy, maize, and coconut, and focusing on expanding cinnamon cultivation as well through Wata plantations. Further, the company's oil palm replanting strategy 3 years ago is expected to result in an 8 to 10% increase in yields per annum through financial year 2023 and 2026. Wata's Wata's subsidiary Wata Dairy Limited manages a herd of 1,670 dairy cattle with 774 milking cows. The operation consists of a milking parlor, which has an annual production capacity of over 6 million liters. Dairy operations generate a relatively small contribution of 17% to the agri segment's revenue and 10% to EBIT. Full commercial operations in the dairy segment commenced in February 2018, following an LKR 1.9 billion investment in March 2016 by Wata as a joint venture with Duxton Asset Management Private Limited. Further, Japan's SBI Group invested $2 million in Wata Dairy in May 2021. The funds were utilized to expand the herd, improve infrastructure, and strengthen the upstream value chain. Farm gate prices recorded LKR 126 per litre in the second quarter financial year 2022 and is currently around 134 rupees per litre. Wata enters into forward contracts with leading dairy brands for its production. The company increased the number of cattle by 127 in the third quarter of financial year 2022, and another 127 cows are expected to be added to the milking herd by the third quarter of financial year 23. The dairy segment is expected to continue contributing steadily to the agri sector, given the demand for fresh milk and strong farm gate prices, coupled with the increase in milking cows the second half of financial year 23. The company divested Hatton Plantation PLC for LKR 1 billion in the first quarter of financial year 20 and remained largely focused on palm oil. Revenue, which grew marginally by 2.46% year-on-year in financial year 21, is expected to see a 69.08% year-on-year growth in financial year 2022. This is backed by expectations of strong volumes, given that the first half of financial year 2022 recorded a 23.08% year-on-year increase in palm oil volumes, and accounting for the fact that the price of crude palm oil per kilogram is hovering at a peak of around 400 rupees. We expect revenue growth to ease to 6% year-on-year in financial year 23, accounting for the 8% year-on-year volume growth, and a conservative assumption that average selling prices will marginally decline despite the expected LKR depreciation. As mentioned before, the company is expected to be a key beneficiary of the imminent rupee depreciation and the current elevated freight costs. As a result, we expect sector EBIT margin to average near 60.5% in financial year 2022 and 61.76% in financial year 23. Wata's financial position is strong with debt to equity ratio at 22.09 and a cash balance of LKR 1.89 billion as of the end of first half financial year 2022. Further, additional capex is limited as the company has already implemented a capacity enhancement of the crude palm oil processing mill to ensure that the plant is capable of handling the 8 to 10% year-on-year increase in yields at the plantations up until 2026. Now moving on to key catalysts associated with Wata plantations. As mentioned before, it is important to remember that Wata is the largest and only certified palm oil producer and most profitable vertically integrated listed plantation and agribusiness. The company is also a key beneficiary of the imminent rupee depreciation and the current elevated freight costs as explained before. The company also has a strong financial position and limited new capex requirements, resulting in the dividend payout ratio being a very high 85% in financial year 22 and 23. The net earnings forecast in financial 2022 is 3.77 billion, which is a 126.68% year-on-year increase. And we have conservatively forecasted a net earnings of 4.09 billion in financial year 23, which is a mere 8.58 year-on-year increase, as we haven't accounted for the benefit from the imminent LKR depreciation in our forecast. It is also important to note that the profitability is the highest amongst any listed agribusiness. Moving on to the valuations, Wata is currently trading at a discount to listed local plantations exposed to palm oil and dairy companies, which trade at an average PR of 14.41 times net earnings. We expect Wata to trade at a modest 11 PE, which is a 23.7% discount to its peers. This results in a fair value of LKR 221.5 rupees, which provides an upside of 30.49% based on financial year 23 earnings. Given the expected 85% dividend payout ratio, as there are no immediate capex requirements in financial year 22 and 23, we forecast a strong dividend yield of 9.28% in financial 22 and 10.08% in financial year 23, making the counter attractive for investors that prefer counters with high dividend yields. This is a slide on the current trailing 12-month PERs of palm oil related companies as well as dairy related companies. Wata's peers currently trade at a PER of average 14.78 times and a PBV of 2.48 times. As mentioned before, Wata is the largest and most profitable agri-related listed company on the CSE, with revenue linked to USD, protecting investors from LKR depreciation. The counter thus should trade at a premium to the sector, but we have conservatively assigned a PER of 11 times for the fair value calculations. Wata currently trades at 9.16 times financial year 2022 net earnings and a conservative 8.43 times FY23 earnings, as we have not accounted for the benefit arising for the LKR depreciation. We forecast a 3.8 billion net earnings to equity holders in financial year 2022 and LKR 4.1 billion in financial 23. The return on equity is forecasted at a very high 73.4% in financial year 22 and 44.75% in financial year 23. The debt to equity is a very low 9.21% and 5.27% in financial year 22 and financial year 23, showing the company's strong balance sheet. The company has the ability to leverage off its balance sheet in the future and pursue expansion opportunities without reducing its dividend payout ratio. The current ground situation of the local banking system is that there is a severe shortage of USD in the market for importers to open LCs. In our view, it is a matter of time before the LKR is floated to 230, and we expect this to occur by the end of March 2022, and to increase further to 250 by end of March 2023. If this scenario unfolds, Wata will be the beneficiary of the LKR depreciation. As the company enters forward contracts with its buyers, it is unlikely that the company will benefit from the LKR depreciation in financial 2022 and in the first quarter of financial 2023. We have assumed the company will increase ASPs in the second quarter of financial year 23 and then again in the fourth quarter of financial 23 in line with the LKR depreciation. We forecast net earnings to remain unchanged in financial year 2022 and remain at 3.77 billion. But in financial 23, we expect earnings to increase to 4.87 billion, which is a 29.24% year-on-year growth if this LKR depreciation unfolds as per assumptions. Under such a scenario, we forecast that Wata trades at a PER of 9.16 times FY22 net earnings and a low 7.08 times financial 23 earnings, respectively, at a discount to its listed peers and the broader market. As stated before, we expect Wata to trade at a 11 times PER based on FY23 net earnings. This results in a fair value of 263.5 rupees with an upside of 55.23% if this depreciation scenario unfolds. We forecast a strong dividend yield of 9.28 in FY22 and 12% in FY23. Now let me hand over the floor to Divya to present Sunshine's other sectors in detail and the associated valuations.
Thanks, Hasita, for the detailed overview on Valuations. Now let's move on to the other segments of Sunshine Holdings. Sun owns 100% of the FMCG business through Sunshine Consumer Lanka, which was established in 1998. The company is the market leader in local branded tea with approximately 48% market share. Unilever, Dilma, and few other regional players are also present in the market. Sri Lanka's modern retail penetration is low in comparison to the region at 16%. Sun's branded tea products has a strong presence in the growing number of modern retail outlets. Sun offers multiple brands catering to a wide range of customers. Zesta, which accounts for 20% of the branded tea segment revenue, is the premium brand and caters to both the local and export markets. Wata, which is the mid-range brand, accounts for 60% of the branded tea segment revenue, while Rankahata caters to the lower income segment. Branded tea volumes decreased 2.3% year-on-year in the second quarter of financial year 22 compared to the 21.3% year-on-year growth recorded in the first quarter. This was mainly due to the adverse impact on the Rankahata brand owing to the decision taken by the state-owned supermarket chain Satusa to retail only state-owned company products from the second quarter of financial year 22. Despite the negative impact on volumes, in value terms, a growth of 25.3% year-on-year was recorded in the first quarter of financial year 22, and a growth of 1.8% was recorded in the second quarter of financial year 22. The increase in selling price of approximately 2% on the larger pack sizes during the first half of financial year 22 also contributed to the increase. Branded tea segment contributed 75% to segment revenue and 60% to net earnings in the first half of financial year 22. Sun is the market leader in hard-boiled candy. The confectionery segment contributes 25% to segment revenue and approximately 40% to net earnings in the first half of financial year 22. Sun's growth plans for Dainty in financial year 22 and through to 23 is expected to result in an increase in contribution to segment revenue. The group entered the confectionery sector by acquiring the market leader in the hard-boiled candy sector, Dainty Limited, for 1.7 billion rupees in August 2020. The acquisition has enabled Sun to become one of the largest FMCG players in Sri Lanka. The company has two main brands, Dainty and My Lady, and primarily caters to the rural economy. Other brands include Benson's, Cheeto, Chicks, Extra, and Mr. Bits. The group has over 31% market share within the toffee segment. This segment accounts for approximately 70% of Dainty's revenue. Main competitors within the toffee segment is Perfetti and Dali Butler. The group has 70% market share within jujubes and 5% market share within chocolates. Sun has a distribution network of over 90,000 outlets and 2 manufacturing sites, which maintained a capacity utilization of over 80% during the second quarter of financial year 22. The confectionery segment was adversely impacted by the closure of general trade outlets and the closure of schools during the pandemic-led lockdown imposed in the first half of financial year 22, which resulted in a slowdown in demand. However, a pickup in demand is expected, although at a slower pace, given the current economic environment. 80% of the raw material requirement of the confectionery sector is imported. Key raw materials, including liquid glucose, is imported, while sugar is purchased from local traders. The cost increases have resulted in a challenge to maintain selling prices and operating margins. As reflected in the graph, the sugar prices increased by 47.03% year-on-year in April to November 2021 compared to the corresponding period in 2020. Consumer sector revenue grew 12.18% CAGR in financial year 16 through to 20. A revenue growth of approximately 30.77% year-on-year was recorded in financial year 21, with revenue at 7.12 billion rupees following the acquisition of Dainty. Going forward, the company plans on growing the Dainty business through a significant increase in brand spending, introducing new variants, expanding and improving existing products within the segments, and also expansion in modern trade, given Sun's strong existing presence in modern trade through branded trees. The company is also looking at rationalizing their distribution network between branded tea and the confectionery segment, which is expected to result in cost savings. The company was successful in diversifying funding sources and obtained a long-term debt facility of $5 million from IFC in June 2021 for consumer sector investments. Draw your attention to the graph, which reflects the revenue and EBIT margins of the sector. We expect the FMCG revenue in the second half to be impacted by poor consumer sentiment in the continued pandemic environment and record a slower growth of 12.64% in financial year 22 forecasted earnings, with the forecast at 8.03 billion rupees. Considering the growth plan for Dainty and the strong branded tea volumes, we forecast a revenue growth of 18.51% year-on-year in financial year 23, with revenue estimated at 9.51 billion rupees. EBIT margins are expected to be relatively low in financial year 22 at 5.73% compared to 8.15% recorded in financial year 21. However, EBIT margins are estimated to be higher at approximately 8% in financial year 23, led by expected increases in average selling prices of D&T in the first quarter of financial year 23 and strong volumes expected in both subsegments. Sun is Sri Lanka's only fully integrated pharmaceutical company. The group's effective holding in the healthcare sector companies amount to 72%. The company operates within all segments of the supply chain, including research and development, manufacturing, importation of pharmaceuticals, medical devices, distribution, and retail. The group has its own distribution network with a reach of over 2,500 pharmacies, 1 warehouse, and 5 distribution centers. Sun represents over 75 leading prescribed brands locally. They represent key pharmaceutical principals, including Novo Nordisk and Abbott, etc. Before discussing the healthcare segment of Sun, let's take a few minutes and look at the industry dynamics. The public sector controls majority of the local pharmaceutical industry through the State Pharmaceutical Corporation and its retail outlets. SPC distributes generic drugs at affordable prices in comparison to the private sector, which markets branded drugs. Sri Lanka imports approximately 85% of the country's medicine requirements. As reflected in the graph, medical and pharmaceutical imports amounted to $640.7 million from January to September 2021. As you can see in the pie chart reflects the market share of the main private sector players. Among them, Hemas maintains 30% market share. Sun is the second largest pharmaceutical importer and holds 12% market share, followed by Emakemi and A. Bowers, CIC, and George Stewart's Health, with a market share of 11%, 5%, 4%, and 3% respectively. All pharmaceutical prices are controlled by the National Medicines Regulatory Authority, out of which 70 molecules are gazetted. Sun's pharmaceutical portfolio consists of over 300 molecules. 40% of products within Sun's pharma business are gazetted with price controls. NMRA's approval is also required to increase the selling price on products which are not gazetted. The maximum retail price of 15 gazetted molecules were increased by 9% in August 2021. The full impact of which is expected to materialize in the second half of financial year 22. Further, selling prices of non-gazetted products within Sun's portfolio were also increased in February 2021 and is reflected in the first half financial year 22 revenue. Sun acquired Akba Pharmaceuticals Private Limited for 2.32 billion rupees in January 2021. This includes Akba Pharmaceuticals, Lena Manufacturing, which focuses on respiratory pharmaceuticals and devices, and Lena Spiro, which manufactures metered dose inhalers. The acquisition positions Sun as Sri Lanka's first fully integrated healthcare company. Annual capacity of Lena Manufacturing stands at 1.6 billion units, and Lena Spiro stands at 2 million units, positioning Sun as a leading local manufacturer of respiratory products. Lena Manufacturing is expected to obtain NMRA approval for a number of molecules and commence manufacturing for a new government tender from the first quarter of financial year 23. Key competitors within the manufacturing sector include State Pharmaceutical Manufacturing Corporation and private sector player Morrisons Limited, owned by Hemas Holdings, which holds the largest general oral solid dosage and oral liquid dosage capacity in the country. We expect strong growth potential of the pharmaceutical segment, considering Sri Lanka's aging population, where 17.56% of the population are over 55 years of age, and the high spread of non-communicable diseases, which cause 80% of deaths. Medical and surgical devices is the second largest segment within Sun's healthcare sector and generates the highest operating margins. Sun is among the top 3 local players within the segment, with Technomedics being one of the other 2 of the large players in this space. Surgical devices segment was impacted to some extent during the lockdown period due to postponing of selected surgeries. Medical devices, however, recorded steady growth over the years, fueled by the government hospitals and the large private hospitals and their laboratories being fully serviced under this segment. Medical devices segment is expected to record strong contribution to the sector, mainly led by the demand from the government district hospitals and Sun's strategy to focus on small private hospitals outside Colombo. The pie chart reflects the revenue contribution of the healthcare sector. As indicated in the pharmaceutical imports, it is the biggest contributor, accounting for over 60% of revenue, with medical and surgical devices contributing 20% of sector revenue. Manufacturing and retail sectors account for 10% each, respectively. Now that we have discussed the pharmaceutical segment and the manufacturing segment, let's move on to the retail subsegment. Sun's retail operation is carried out through HealthGuard Pharmacy Limited. HealthGuard offers a range of pharmaceuticals, wellness, and beauty products in 22 outlets located in Colombo and suburbs. The pharmacies primarily targets urban consumers with high purchasing power. Transaction volumes were adversely impacted during the pandemic-led lockdowns. However, bill value per customer recorded a significant increase, resulting in robust growth. Top-line growth was largely driven by the wellness segment, which generates higher margins and is a key focus area going forward. The company plans on expanding retail stores and improving online presence. The company is also investing in technology, including a cost and warehouse management platform for seamless integration, and also is looking at increasing targeted ad spend by focusing on data analytics for HealthGuard's loyalty base. The graph captures the main competitors and the number of outlets managed by each of them. HealthGuard faces indirect competition from the State Pharmaceutical Corporation, which distributes medicines via its large network of 211 Osusala outlets. In addition, it also faces direct competition from pharmacies located in modern retail outlets, including Cargill's with 440 outlets, Keel's with 116 outlets, Arpico with 49 outlets, and Laughs with 38 outlets. Sun's healthcare sector revenue grew at 12.26% CAGR in financial year 16 through to 21. Strong revenue growth of 54.27% year-on-year and 41.95% year-on-year was recorded in the first quarter of financial year 22 and second quarter of financial year 22 respectively. This was led by the growth in existing pharmaceutical and devices business segments and newly acquired Akba Pharmaceuticals. Going forward, we expect a strong revenue growth in the segment with a 40.13% year-on-year revenue growth in financial year 22, with revenue recorded at 17.89 billion rupees, and a 15% year-on-year growth in financial year 23, with revenue recorded at 20.58 billion rupees. The increase is expected to be driven by growth of the medical and surgical device segment, given the increase in testing and collection centers by leading private sector hospitals, and planned expansion and improvements in HealthGuard pharmacies. The newly acquired manufacturing businesses are also expected to support revenue growth. EBIT margins are expected to average at 8.9% in financial year 22, where the likely rupee depreciation is expected to be mitigated to some extent through the increase in selling prices. However, we conservatively forecast EBIT margins to be lower at 7% levels in financial year 23, mainly led by the expected rupee depreciation and the time lag associated with the increasing selling prices due to the MRP controls in place. Now that we have looked at the main segments, let's take a quick look at the rental income earned through investment properties. The group, through its subsidiaries, have a significant land bank of over 2,874 purchase across Colombo, Kalutara, and Kurunegala districts. The properties are valued at 1.76 billion rupees. Rental business contribution to group revenue and EBIT was insignificant in the first half of financial year 22 at approximately 0.13% of total revenue. A similar contribution has been maintained over the forecast period. The investment management and services segment includes holding company operations of Sunshine Holdings and Sunshine Wilma Private Limited, which is the holding company of Wata. Dividend income received from group's investment are reflected within this segment. This segment contributed 5.3% of revenue and 22.33% in EBIT in the first half of financial year 22. However, majority of the contribution is eliminated at the consolidated group level under intra-group adjustments. Going forward, we expect the revenue in financial year 22 to be recorded at 1.6 billion rupees and 1.77 billion rupees in financial year 23. Having had a closer look at segmental performance and outlook, let's take a few minutes to look at the consolidated position of the group. The revenue is expected to record a strong growth of 34.29% year-on-year in financial year 22, with forecasted revenue at 32.69 billion rupees and a growth of 14.22% year-on-year in financial year 23, with forecasted revenue at 37.33 billion rupees. Growth is primarily driven from the forecasted significant increases in healthcare and agri sectors and modest growth in consumer sector. Group EBIT in financial year 22 and 23 is expected to be led by agri, healthcare, and consumer segments. Agri segment is expected to continue to generate the highest EBIT margins of 61.76%, followed by consumer at 8% and healthcare segment at 7% in financial year 23. At a consolidated level, EBIT margins are forecasted to increase to 18.46% in financial year 22 and reduce marginally to 17.78% in financial year 23, owing to the decline in healthcare segment EBIT margins in financial year 23. Considering the factors previously discussed, we forecast net earnings attributable to equity holders, which grew at 71.64% year-on-year in the first half of financial year 22, to record an increase of 42.17% year-on-year in financial year 22 to LKR 2.16 billion rupees. Net earnings in financial year 23 is forecasted to increase 19.32% year-on-year to 2.58 billion rupees. The earnings growth over the next 2 years is mainly led by the contribution from recent acquisitions of Dainty and Akbar Pharmaceuticals and strong growth prospects from the palm oil business. Also, medical and surgical devices and health guard pharmacies will also contribute to the growth. No significant new capex is forecasted in financial year 22 and 23, considering the recent acquisitions. Thereby, debt to equity is expected to continuously decline from 32.76% in financial year 21 to 15.7% in financial year 23. Sun is open for new opportunities to enhance their offering and grow market share in the cooperating segments. Moving on to the valuation, Sun trades at 14.41 times and 12.08 times FY22 and FY23 forecasted net earnings respectively. This is a discount to listed local diversified companies and a discount to the broader market PER of 14.82 times. We expect Sun to trade at 12.5 times PER based on financial year 23 forecasted net earnings. This results in a fair value of 71 rupees and 90 cents, providing a 3.45% upside. Please note that this fair value does not consider the imminent rupee depreciation given the shortage of US dollars in the market. As Sunshine is a dynamic company, the management is actively looking at inorganic growth and acquisition opportunities in the core segment as reflected in the transactions that took place in the recent past. As such, new opportunities and acquisitions may generate additional profit and result in further upside in the future. Sun has moved rapidly over the last few weeks since we initiated research on this stock. As such, at current prices, the stock is fairly valued. However, Wata being the most profitable entity of the group, which contributes approximately 53% to the group's EBIT, given the fair value of 221 rupees and 50 cents, an upside of 30.49%, investors may consider that stock in the short to medium term. Sun trades at a PBV of 2.56 times based on financial year 22 forecasted earnings and 2.23 times financial year 23 forecast. Dividend payout is expected at 30%, which provides a moderate dividend yield of 2.08% and 2.48% for financial year 22 and 23 respectively. We have also carried out a valuation considering an imminent rupee depreciation given the shortage of dollars in the market. As such, we expect the rupee to depreciate to 230 rupees by March and 250 rupees in financial year 23. Sunshine is a net beneficiary of rupee depreciation considering its shareholding in Wata. Accordingly, there is no change in financial year 22 net earnings figures considering the time lag associated with renegotiating contracts with existing buyers and suppliers. However, financial year 23 forecasted net earnings increases to 2.89 billion rupees, an increase of 33.79% year on year. Sun trades at 14.41 times and 10.77 times financial year 22 forecasted earnings and financial year 23 forecasted net earnings respectively. This is a discount to listed local diversified companies and is a discount to the broader market PER. The PBV is at 2.56 times based on 22 forecasted earnings and 2.19 times FY23 forecasted earnings. Dividend payout is expected at 30%, and the dividend yield is moderate at 2.08% and 2.79% for financial year 22 and 23 respectively. Therefore, we expect Sun to trade at 12.5 times PER based on financial year 23 forecasted net earnings. This results in a fair value of 80 rupees and 70 cents, providing a 16.12% upside.
We thank you, Hasita, Divya, and the research division for their valuable insights. Now, Mr. Shehan Mendes, Director of Capital Trust Securities, will read out some of the questions that are relevant to many clients, which have been sent through the chat by the audience.
Good afternoon, ladies and gentlemen. We warmly welcome you to another webinar with Capital Trust Research. And thank you, Divya. Thank you, Hasita, for the presentations on Sun and Wata, Sunshine Holdings and Wata. So it's a new addition to our research coverage. And we would like to take any questions from you during the Q&A session. So there's been some questions which we've been getting. Got a question from Mr. Kumar Bharati. The question is, the government of Sri Lanka has taken a decision to uproot 10% annually its palm oil extent. Future replanting has been stopped. What's the future?
Yeah, let me take that one. So having spoken to industry sources, what we've been told is uprooting hasn't really occurred. End of the day, Sri Lanka is a net importer of palm oil, and palm oil is used for various purposes. And the per capita consumption is quite high. And given the current forex issues and limited imports, this uprooting hasn't really occurred. But the replanting, with regards to whatever what they have done is over the last 3 years, they replanted quite a bit. And this is resulting in around 8 to 10% increase in yields year on year up until around 2026. So we don't really expect whatever, for instance, to be really impacted by this government policy, as the regulators aren't as the state is not really implementing this uprooting condition. So we haven't really we don't consider that as an issue for the time being.
There's another question from Mr. Arthur. Since oil prices increase, will this benefit to LPT, Namanukula and Kota also?
Yeah, so what with the palm oil prices increasing, what usually happens is it's a mill that makes the majority of the profits. So Wata has its own palm oil mill, which has around a 50% market share of the crude palm oil produced in the country, whereas LPT, Agalawata LPT and Namunkula own the second mill, which is AEN processing mill. They have the other 50% market share. So majority of the profits are actually made at this mill, whereas the plantation will feed the fresh fruit branches, which goes as the input into this mill. So yes, the fresh fruit branch price will increase to some extent with the increase in the crude palm oil prices. But in terms of the absolute increase in profits, that will come from the mills, and then Agalawata LPT and Namanukula will get 33.33% of that increase in profitability. Whereas Waterwell, on the other hand, will get 100% increase of the profitability because they own 100% stake in the palm oil mill. Whereas Kottagala, for example, will only benefit in terms of the increase in fresh fruit branch prices and not the increase in crude palm oil prices.
There's another question. What's the estimate profit after tax and EPS for Q3 ended 31st December 21? Is it advisable to buy Wata at the current trading rate of 169 rupees a share?
Okay, let me take that one as well. So it's important to understand the seasonality of any business that is exposed to agriculture. So for the palm oil industry, for example, the second half of the year, the yields are lower than the first half of the year. Usually the split is around 55 to 45. 55% of the yield in the first year, 45% of the yield in the second year, if you look at total outputs. So we have conservatively forecasted a slight reduction in the profitability in the second half of the year compared to the first half of the year. And that will be the same even in the next financial year. So we advise clients to advise investors to look at the total profitability for the year and not quarterly profits for companies that are exposed to agriculture. But if you look at the total profitability, we are forecast anything around 3.77 billion. That's without the depreciation expected in the country. And in terms of next financial year, if we look at the depreciation assumption, I think we have about, I think it was around 4.7 billion. So if you look at the total earnings expected for FY22 and FY23, as well as the dividend yields expected, then the share is very attractive at these prices.
There's a question from Khalindu Hera. Sun is an importer, so how can depreciation of exchange rate improve its fair value?
Right. So Shahan, actually the main elements, the main segments. So if you look at, yes, in terms of the healthcare segment, will be affected by the rupee depreciation. But also, I mean, if you look at even in this year, there were two price increases. I think one which was gazetted and which came into effect in August 2021, and also the non-gazetted products, there was a price increase in February 2021. So we feel that that they will have a chance to actually increase prices, but there will be a time lag associated with that increase. Same with the consumer segment as well. So we have factored that into our calculation, and that is why conservatively we have actually expected the EBIT on those two sectors to marginally come off in financial year 22 and then recover in financial year 23 because of this time lag. But still looking at that, Sun overall is a net beneficiary of rupee depreciation given its shareholding in Wata. Like if you look at the EBIT contribution at consolidated level, Wata contributes about 53% of EBIT. So looking at that, actually Sun is a net beneficiary from rupee depreciation. I hope that clarifies, Shahan.
Yes. With the palm oil prices now elevated and there's a global food shortage also, which is being talked of, where do you all see the palm oil prices going to be in the next few quarters?
So just listening to what the palm oil, the Global Association for Palm Oil, what they've been saying is they expect prices to increase up to March 31st, and which is, if you look at the last few days, you could have seen an increase in the index and touching coming close to the all-time high again. So we, because of unfavorable weather, lower outputs in Malaysia and Indonesia, that's sending the prices higher and higher. So we expect that trend to continue until 31st March. And then for financial year 23, we're expecting prices to be elevated but ease from the peaks because the labor shortage, for example, in Malaysia, more labor will be permitted, which will increase production to some extent and reduce the prices in dollar terms. But what we need to understand is basically for Wata enters into forward contracts with its main customers, which is around 3 to 6 months. So the increase in global prices will only impact their ASPs with that time lag. So that is the reason why we had maintained the current ASPs for the fourth quarter of FY22, and we're only increasing ASPs even if in a scenario where the rupee depreciates in the second quarter of financial year 23. So that's where we see the ASPs heading in the shorter and medium term.
In terms of valuation, I just noticed we have taken a different approach based on the current facts available to us. We have post-stamped a particular fair value, but given few scenarios also based on the rupee depreciation, any insights on that would you like to share with us?
Yeah, Shan. So actually, I mean, in reality, there is a significant shortage of dollars in the market. Importers are unable to open LCs. I mean, there's a queue at banks to actually get the dollars. So, I mean, we feel that a rupee depreciation is imminent. It is a matter of time. So that is why we actually feel that in terms of the fair value, that what should be considered is in line with our expectation of the rupee depreciating to about 230 by end of this financial year, and even 250 by next financial year. So we just showed the two scenarios for investors in terms of their knowledge as well. But we feel that the rupee depreciation is imminent and it's a matter of time.
There's a question from Equin Piris. Sun's current value, current price is 69.5. Your fair value is 70. I think the question is whether to buy at the current prices. Does it, since it doesn't offer good enough margin for a good profit?
Sure. So let me take that, Shahan. So actually, considering the rupee depreciation, our fair value is actually 80 rupees. So that does give you about a 16% or so upside on Sun. And like we mentioned, okay, this fair value was arrived at considering the current, sort of the current operations and the facts that we have at hand. However, Sunshine is a very dynamic company. I mean, if you look at it in the last 2 years, they have restructured their operations. They're focusing on core segments. They have done acquisitions to enhance their, enhance their presence in their core segments. So we haven't factored in any of this growth that is coming, possible growth that is coming through inorganic acquisitions, which we need to keep in mind when we take a long-term view on that counter. So yes, in terms of maybe say short term, the upside might look like 16%, but we have to keep these factors also into consideration. Wata, on the other hand, like Hasita mentioned, is the cash cow of the group at the moment, given the performance in palm oil as well. So there's significant upside on that counter.
There's a question from Gaurav Lianage. Can Wata replant or start a new palm oil plantation under current government restrictions? I think we touched upon this topic earlier also, but would you like to share something on that also?
So Wata has no immediate plans to replant. They replanted 3 years ago, and there's a gestation period for palm oil, obviously, and this is yielding results at the moment. So as I mentioned before in the presentation, their yields are increasing by 8 to 10% year on year, and this will happen until 2026. So there is no immediate requirement to replant. They won't be impacted by the current regulation as such. But the regulation says no replanting and uprooting has to happen. But as I mentioned before, no uprooting is occurring at the moment. But in terms of Wata Valuations operation, there is no replanting happening at present.
There's a question from Mr. Sudarsan. The question is, Sun moved from 25 to 45, then to 60. Why Capital Trust is now giving a research on this at this point in time?
Okay. So Shehan, we actually, sort of commenced research on this counter even a few months ago. But there is an in-depth process and sort of significant details that we gather before we publish any report. So saying that, I mean, we go into sort of details from a macro level in terms of sort of, what is affecting the industries to what's going on, things like that. So it's a fairly detailed research. So, I mean, yes, it has moved, but saying that, I think we started looking at this counter a couple of months back. But it has rapidly moved, the price has rapidly moved over the last few days, actually, Shehan. But saying that, in terms of, our view on the counter is still positive. And looking at the rupee depreciation scenario, there is a 16% upside on financial year 23 forecasted earnings. That also just looking at the current operations and not necessarily looking at the possibility of sort of inorganic growth coming through future acquisitions and restructuring of activities.
Yeah. And Divya, is it like safe to say now, since we have the reason we have added this counter to our coverage, is it merely to make a capital gain, or is it because this stock also offers the same, it has the attributes that to cover against take hedge against the rupee depreciation and inflation? Could we say that people should look at it from that point of view than merely making a capital gain?
Yeah, definitely, definitely, Shehan. I think one thing is, if you look at, okay, it is a beneficiary of rupee depreciation, considering Wata. And if you look at Wata also, I mean, if you look at the three main segments that they operate in, if you look at Wata, it's actually, sort of a very important element of this whole thing. The other two segments within consumer also, they are the market leaders. I think if you look at the tea segment, they have about 48% market share. And in the consumer segment, within the hard-boiled candy space, also they have a significant market share. Within the pharmaceuticals and healthcare sector, next to the state and next to Hemas, they're the second largest. They have about 12% market share. So they are a company, sort of dominating in the sectors that they're operating, and they have focused on further enhancing their offering within those sectors. So we have looked at all these elements before we have initiated coverage and before we have put out these reports.
There's a question from Murtaza Akbar Ali. Cost of water effluent treatment is critical for palm oil production. Does Wata has its own plant or is this subcontracted?
So good question. So this is one of the big concerns for investors with regards to palm oil. So palm oil is, I think, water oil is still South Asia's only roundtable on sustainable palm oil certified palm oil business. So yes, with regards to water treatment, they have their own plant and they handle it in-house, to my knowledge. And the certification looked at all of these elements, whereas the other for AEN at the moment doesn't have these certifications because they are yet to meet these conditions. But whatever, on the other hand, meets the sustainability conditions and has the RSPO certification.
There's another question, bit off topic from Waterwell and Sunshine, but I'll take it for the benefit of the person who asked the question. From Mr. Sudesh Gamage. I found some owners of WhatsApp groups saying that they have bought Sampath and Amana and telling everyone that banks are undervalued. Should we buy banks now or wait for 6 months to buy?
I'll take that question, Shahan. So if you look at, banking and finance sector companies, they are operating in a very challenging environment, due to the impact of COVID-19 affecting its borrowers and the repayment capabilities. Then Sri Lanka has had multiple credit downgrades. Then there's a US dollar shortage in the market. In addition to these factors, they are also impacted by the one-off surcharge tax, as well as the social security levy. Then other than this, if you look at the debt moratoriums in itself, there's been an extension on the debt moratorium for COVID affected business and individuals, where the moratorium has been extended to the 31st March 2022. And for tourism related businesses, where the moratorium was extended to June, 30th June. So we feel the actual NPLs will be higher in the coming months once these moratoriums come to an end. Also, interest income at the moment can be overstated because these moratorium loans, the interest income on the moratorium loans are reflected in their profitability. So we feel that, we need to adopt a wait and see approach. Also, we mustn't forget about inflation. Like if you look at inflation in December, the headline inflation was 12.1%, food inflation was 22%. In reality, inflation would possibly be much higher than this. And given the possible rupee depreciation and increases in commodity prices, inflation would most likely get even increase even more. So we expect a slowdown in the economy, and this will also negatively impact the banks because there would be possibly be slower credit growth and higher NPLs. Other than that, the main asset of the bank is also receivables. So you have to know the value of that receivables is also going down because the of the purchasing power of the rupee. So we mustn't forget all these facts. So yes, when you look at the valuations in isolation, there is no doubt, yes, it looks attractive. But if you look at, commercial bank is at a PER of 3.86 and a PBV of 0.57. HNB is at 3.99 and a PBV of 0.43. Sampath Bank is at a PER of 4.66 and a PBV of 0.5. But we can't look at the valuations in isolation. We have to look at the other factors that we discussed. So we believe in adopting a wait and see approach to see the full effect of all of this that would come into the financial statements, most probably in the second half of calendar year 2022. Is there anything else, Hasika, to add to that?
Just one thing to add is basically in the current context with the credit downgrades and the current economic conditions, banks represent the underlying Sri Lankan economy. So in our view, the economy is going through hardship and it's struggling at the moment, and the banks will represent that. Our investment thesis is, yes, looking at counters that will provide you protection against this underlying economy. And in our view, there'll be other counters that will provide that, and the banks wouldn't. So for that reason, we'll wait and see until the economy recovers and the banks have a rosier future. At the moment, we don't see that. So for that reason, we're just adopting a wait and see approach.
I think it's more in terms of visibility, in terms of what is actually going on and how it will impact their, P&L and balance sheet.
So since we don't have any further questions, we would like to end the Q&A session. Thank
Just
you.
one thing to add to that, Shayan, sorry. As what we were saying before was, yes, what we have been recommended, the whole capital trust investment philosophy is, yes, the economy is going through a hard time, currency is going to be depreciated eventually, and we need to find a portfolio that will provide protection against that. And we would suggest that investors do follow certain counters that we do, in our opinion, provides that protection and will outperform the general economy and the general market. So that is our recommendation.
Yeah, so essentially, we're sticking to our counters, that have dollarized assets, dollarized earnings like LOLC bill, then dollar earning companies like Expo, market leaders in various fields like RCL, Tile Group, and ACL that can be market makers and can actually manage this rupee depreciating environment, and also counters that we have recently added like Wata and Sun.
Thank you, Divya and Hasika, for those for sharing those insights with us. And since we don't have any further questions, we would now like to hand it over to Prashant.
Since there are no further questions, I would now like to close the webinar. We want to keep our webinars concise and relevant, but we assure you we will be back in 2 weeks. On behalf of Capital Trust Research Private Limited, I wish to extend a sincere thank you for our valued clients for their support and continuous trust in us, and for our staff who helped to organize this webinar. Thank you very much. Have a nice day.